Yeah, so this consolidation that's happening, like there's going to be a move that comes out of this. There always is. Like the stock market doesn't like going sideways for very long. But is it going to be an upward move? That's the question. I think so, just because of where growth is. But obviously, anything can happen. We could get a move down to Momo. Momo's actually been catching up quite a bit. Do you think that's a possibility? Like, is that something that you
Yeah,
see happening?
yeah. So I think the biggest factor is to understand obviously where we are right now in terms of the regime, right? Once you can isolate the regime, which we have an active tracker in the daily quant deck that update or the quant deck, excuse me, that updates daily, that shows you or and gives you an indication of where the market is and is heading, and it tends to front run the market pretty well, so it's not so late in terms of giving you the indication on where risk is moving. It's actually quite early, so we use that to our advantage and we build our models around that. But getting back to what you were saying, I think that there's a good possibility the market can break up from here. And if we just take a look at QQQ, it's easier, um, obviously, given that there's no extended hour trading on the Qs here. It's easier to see what's going on. And you can really see that ever since like February 12th, up until today, the market has gone. If you take the close of yesterday, and we're recording this on Thursday, so if you take the close of Wednesday, CPI day, the market literally didn't go anywhere from February's highs, early February's highs, until today, where it's
Yeah,
now
and
closing higher.
we're also heading into earnings season right now. I think with earnings season, there's a high chance that the Nasdaq could end at around 500 after earnings season. Like if companies really do kill earnings, and growth has been strong. Like even during this flat period, our system has been rising in growth. So
Yeah,
it's definitely a possibility. And coming out of a consolidation period this long, like it's been over a month of this consolidation now, the move
yeah.
could be
Like
pretty
I
vicious, I think.
like I said, we're up like 1.5. Oh no, we are up 1.55% since or above the February 2024 highs. So it's not like this market's run away. And in the process this year, the Qs are up, I think, what, nine, not 7.24%, right? Something like that.
Yeah.
So it's interesting, right? So the market's up like 7%. And we've seen a lot of this cope or whatever you want to call it fade off since the beginning of the year because you remember coming into this year we had this dip in the Qs and everyone was like, oh, the market's going to pick the first couple of weeks to determine the like next couple of months in terms of market direction. Dead wrong there saying that nonsense, right? They pretty much got smoked rather quickly. By the end of January we were at higher highs, and this type of rally ever since November, October, lost a lot of momentum after like February. We stopped making really we stopped breaching and exceeding the prior highs. We were printing new all-time highs like here and here, and every couple of weeks there was a new all-time high, but it wasn't really so much legging higher the way we were seeing it. So that kind of cope where the market's up in a straight line, is the market still up this year? Yes, but now we're going into quarter two with the market up 8 to 9%, depending on what index you're looking at. And a lot of that annualization nonsense stopped, right? Because there's a lot of people in like that were taking the first couple of months of January, right, and saying like, oh, if the market goes up like this, they basically what they were doing was linear linear economics, where they were drawing like a line saying like, oh, if we annualize this return, then Nasdaq's going to be like up 80% or whatever it was percent at the end of the year. Impossible, right? And like we've seen that linearity break down to a degree, right, in terms of a slowdown in those gains. So now your next question is, well, depending on what risk environment we're in, the direction is going to be very, very important from where we go from here. So, like, if we are in a risk off regime, we would expect to go to Momo, right, and get that bearish trend flip, and then let the market roll over
Well,
and
the
and,
thing is
and
though,
go
is
lower.
even in a risk on environment, which we are in right now, we have been in for a while, a dip down to Momo is possible and still maintaining that risk on environment.
Right. So I think what we have to the first step is obviously determining what risk environment you're on, right? So if you're in risk on, right, dips to Momo should hold. If you're in risk off, dips to Momo should not hold. So if you just look at the cues here and how we've been consolidating, right? You break up above here. Okay, we have a lot of people that are claiming the highs for the year are possibly in. That gets invalidated, and you have a lot of people that um, got liquidated or decided to go to cash based on the jobs numbers or the CPI numbers or accelerating inflation, if you understand what I'm saying. So a lot of those people are very emotional because there's no inflation has not there is no signs of material inflation reacceleration. No matter how you want to just dissect the numbers are pretty simple. We'll go over that in a little bit, but it's not material enough to really break this market down, obviously, right? So far, and a lot of people may have jumped the gun there. And once we get back above all-time highs, you kind of create this bag chase environment where people are like, "Well, I sold out. The hot inflation was supposed to crash the market. It didn't, and I say hot keenly, right? But it was supposed to crash the market. It didn't. Now might be time. The market's going to just keep going up. I might as well just buy back in, and that's what kind of creates those moves where the market legs higher materially. And you're right, we have earnings season coming up, so that's going to be interesting. Depending on how companies guided the last quarter, did some companies set up their earnings for beats with sandbagging expectations for the first quarter or for the fiscal year? And are we going to start to see signs by quarter two that some of those Q1 slash Q4 guidances and expectations are too low, or are they too high? And are we going to see the market come in on that? I think that given where the economy is right now, where growth is, and where some of the more important companies in the market are, I think we're going to have a good outcome from earnings season. We'll have to see. Obviously, regime and trend are the key here, right? Regime's number one priority, and then comes the trend, and then comes liquidity, and then comes all of our biases on the bottom. A lot of people like to put the biases on top, and they get wrecked in the process. So I think with that, we can move on to bonds, right? Bonds, interestingly, closed bearish trend this week, kicking off a bearish trend for the first time since late 2023.
Yeah, I'm actually surprised that bonds were a little bit surprised from the latest CPI numbers. And
Yeah, that
we
was
also had some cuts come off the table for the year as well after that print, which was kind of shocking because it really wasn't much of a beat, or like we were what, 10 basis points higher than expectations.
less than. I think it was 6.
Yeah, so it's really negligible, which I'm kind of surprised that we got the move that we got in bonds based off that.
Interestingly enough, you say about bonds, but I think bonds, obviously, if we go back to the compound landing, right? Stage three. Stage three is the normalization stage within the compound landing. And for those that are just listening and don't know what that is, the compound landing, it is our macro framework for this specific regime. The compound landing is not something that typically happens, and it likely won't happen again, at least for quite some time. It's specific to an accelerated hiking, or what it basically is. It's the outcome of rate cuts, massive inflation, the Fed being behind the curve, an accelerated hiking environment, and then a too high for too long restrictiveness environment to where they over tighten, and then we get the final stage of the four-stage compound landing, which is stage four, the hard landing. Stage three is normalization. And within stage three, what happens is the economy attempts to normalize at the higher levels of interest. Now, what I mean by that is a lot of people like to throw out the word the neutral rate or star, or however you want to simplify it. The neutral rate is basically the rate at which the economy is not expanding and not contracting, and that rate is the interest rate that the Fed can control, right? Or where the Fed should be above and below. The Fed is controlling the short-term Fed funds rate, and they are lifting that above or below the neutral rate to either stimulate or stimulate or tighten the economy. And that neutral rate, there's a lot of arguments now saying that the neutral rate is much higher than it was historically. And no one really knows where that neutral rate is, but it's the idea that the Fed is not tight enough or financial conditions are still quite loose with the Fed at 5%. And a lot of these arguments are being brought up because the Fed is so far into their hiking cycle, right? That people assume that the effects of what the Fed has already initiated have bled into the economy. But in reality, we're only what? We're less than 2 years into the hiking cycle, just about 2 years in, right? And we've gone from zero pretty much to 525 basis points. And that's a lot of time, a lot of policy action in not so much or not so wide of a time horizon. And I think that the claims that the neutral rates can shift, yeah, the neutral rate probably does historically, like a sine curve, go up and down depending on financial conditions where we are at that time. But to argue that the Fed isn't restrictive at 525 basis points because the stock market's at all-time highs, it's just such a poor, unfounded, or really poor based argument, right? You can't make that based on because the stock market's hitting all-time highs or because equity prices are at all-time highs, the Fed isn't restrictive. When the Fed is in the midst of an inflationary, or at least we just came out of an inflationary recession, right?
Yeah.
So, like, inflation's running so hot that, or was running so hot, we went all the way up to 10%. Now we're at 3.5, right? Um, to say that the Fed hasn't gotten things somewhat under control, I think is just a poor argument. And I think we see a lot of these arguments coming, specifically from the commodity bros and the crypto bros, right? No hate against them. I understand that they have their reasons for their allocations and
I
their
mean,
biases.
that would be bullish for them if inflation goes out of control.
Right, true, but like, so a lot of the crypto guys like to point to the fact that the Fed has lost control, not so much that commodity prices are going to go up, but their case is that the dollar is going to get destroyed, debased, right? Because the Fed is just going to let the government kind of let loose on the standard of what the dollar is because they're forced to. How that happens, we can argue yes or no, but all in all, the dollar's actually not as weak as we don't like to. Everyone like to make it out to be. The way a lot of these commodity and crypto bros are claiming, the dollar should be sub 100, even sub 90, based on these claims. We should see the dollar at macro or recent lows, not budging towards the macro highs here of 23. And like that's not something that you want to see in an environment where the Fed is losing control, right?
Yeah.
Because the demand for dollars should
Well, so
vanish. But
based on how quickly we've been seeing rate cuts get priced out, we were at what, 6 rate cuts for the year at the start of the year back in January, and now we're less than 3.
no,
We're
one
even
point.
lower. We're less than 2.
We're we're less than two now. Yeah.
Do you think the Fed might get put in a position where they actually need to raise rates even more and
Well,
really cause a policy error of over tightening?
I think the Fed kind of. I think most people with a coherent understanding of the macro situation have thrown the idea of rate cuts out the window. Like I think that if you have any type of middle ground understanding, you understand that the risk now is over tightening by holding too high for too long, not adding rate hikes. Rate hikes is kind of like a left field thing that I think that most people aren't even thinking about. But there are some, obviously, there's always some people in macro that say we should be the inflationist bros. They want to see the Fed funds rate at like 8 to 10%, whatever.
Well, I mean,
Non
based on how quickly the market priced out rate cuts, don't you think maybe 6 months from now, near the end of the year, they might actually start pricing in a hike or sometime around the end of the year?
Well, yeah, I mean, I think that if that's a very good argument to take. I just don't think that argument to have, excuse me. I just think the side that needs to be taken here is the fact that you would want rate hikes from here if you believe the Fed is nowhere near restrictive. And I mean, we can look at things like inflation. We can just look at something like the 5-year inflation swap, right? And we're at 2.55. Yeah, we're up nicely off the 2023 lows of 2 points. We're up about a quarter of a point up off the 2023 lows. Inflation expectations have shifted higher somewhat. But again, just understand where we are in context of where we've come from, right? people like to zoom in on this chart. What they kind of like to just zoom in and focus all the way on the right here, and like, oh, look, inflation swaps are breaking up, they're breaking out. We're going back to the highs. And then what you need to do is you just zoom out and you just realize, well, I mean, like, we're quite far away from where we actually had inflation running away from the Fed,
Yeah,
right?
and also having slightly higher inflation but controlled inflation is bullish for assets. Assets are inherently pricing in inflation at all times. Housing and stocks are always pricing in inflation in their prices. So having 3 to 4% inflation is bullish as long as it's controlled.
Correct. And then you have to also look at okay, so you also have to look at the companies that are dominating the market, right? Like, so people like to compare the Nasdaq and like the 10-year. Oh, if rates are up, the Nasdaq can't go up. Well, I mean, bond yields are pretty much at 2023 November levels, and equity prices are I've quite much higher than that, right? And I think there's a big argument to be made here in terms of the equities that are sensitive to rates and the equities that aren't sensitive to rates, like equities that are just cash printing monopolistic machines. Mag 7 is an example, right? Them being so rate sensitive, maybe outside of Tesla, given that they're an auto manufacturer, right? I think there's a different dynamic there. Like, if we look at IWM, the Russell, I mean, that doesn't look anywhere near as good as the Nasdaq or the S&P 500, because these are more rate sensitive companies. So we've said this for a while now. I think the better part of a year at this point, or at least 6 months, that the Nasdaq is very likely going to outperform. Large caps are going to outperform small caps in an environment where rates are in restrictive territory, right? Because if you have rates in a restrictive if the economy was super loose, right, or the Fed's conditions were super loose, small caps would be booming. This is what loose looks like for small caps, right? Like, just like ultra stimulus, loose financial conditions. We're not really even seeing that. I mean, the IWM is yet to hit new all-time highs or even recover to 2021. I think this is just one of many indicators that, look, inflation's, like you said, firm, has some strength, but it's not running away from us. It doesn't have the same velocity as it did in 2021/2022. So I think that you have to take it with a grain of salt. Like, look, take a step back. Inflation came in at 3.5%. The expectation was 3.4%. The Fed's target is 2%. In 2022, this is a 6 basis point miss to the upside, right? In 2022, we were missing to the upside on inflation prints by 20 to 25 basis points.
Yeah, and they were pulling out the transitory card when that was
Yeah,
happening.
yeah,
And
yeah.
now we miss by 6 basis points and oh, it's an issue.
And we remove rate cuts immediately from the market. Like, the market's very sensitive to this. And in some ways, the market's already tightening. Think about it like this: the market's tightening short-term financial conditions, if you want to break it down to short-term, by just removing rate cuts from the market, from the Fed funds futures, right? You're just automatically showing the market the bar has to move higher in terms of policy in the short-term window of the next 10, 12 months.
And that's exactly what's going to bring us into stage 4
I
is
think so.
that
I do
over
think so. Yes.
restrictiveness.
Yes, and we can even look at something like very simple, like this is the United States Economic Surprise Index by Citigroup. They basically put an index together that measures the deviation in the reported versus estimated data. So you can see we're positive. We're quite positive. We're not as high as we were in 2020 when things were blowing out to the upside, but we're up there. We're close to 50. We were seeing that pre-2020, right? And we saw that in 2022, early 2022, excuse me, and throughout 2023. So we're not negative or near the lows. So we're in positive mid to high territory here. And what this is telling you, very simply, is data across the board is beating to the upside. Now, you might say, "Oh, that's bad. Inflation's beating to the upside." Yeah, look, we're talking about 6 basis points. Yeah, it's a surprise to the upside. Look, and we're still under 4%, right? The inflation is still under the Fed funds rate. Just remember that, and by a decent margin. So let's just focus on what is going on here. Slight inflation beat. Okay. And then also look at all the other economic data too. Jobs beating, growth beating, right? All these things that are beating. This is an index of all the data that's showing you that even though inflation is hot, or I don't want to use the word hot because it's really not. It's a slightly above expectations. Yes, it's hot in terms of the Fed's target, but in terms of where we've been historically and where we are now, it's not that bad. And we'll go into that in a second. But in terms of growth and everything, they're also positive. If we go back to 2022 when the market was shitting the bed on inflation prints, what you'll notice is inflation was blowing out to the upside, but all the other economic or I should say data points, right? What this index is monitoring, were printing to the downside. So you had this push up on inflation, but the sum of economic data was surprising to the downside.
Yeah, like we were in a technical recession at that time. We had 2 negative GDP prints.
Yeah, and that's not the market does not. I repeat, the market hates that. Absolutely hates that. And people see warmer warmer CPI now, and they're like, "Oh my God, the market's going to crash." But little do they know that we have GDP now sitting at almost 1 whole percentage point above what the Fed would consider a long-term trend. So I think that you need to take a step back and kind of look at the big picture here. And it's not very hard to do. It's just, there's a lot of noise. Everyone wants to say, "Oh my God, the crash is near." Everyone likes to say that, but in reality, most of the time you need to take a step back. And I want to go over just again, let's talk about inflation, as that was the hot topic this week, right? If we take a look at inflation, we are below the 2018 peak. We're below the 2011 peak. We're above the 2018 peak by 60 basis points, right? A lot of people are saying, "Oh, this is the second wave, we're going to go up." Okay, well, if the market really believed that, if the market really starts pricing that in, we would see a real accelerated move on things like crude. And let's take a look at crude oil. Crude oil is still below the 2023 high. Okay, still below the 2023 high. It's at the same price it was in September of last year and in November the year before. So we need to start to see a material breakout. Now people are like, "Oh, you did off the the stone cold lows, crude's up 26%. Yeah, okay, bro. You measure lows to the most lowest point to where we are now. Yeah, it's up 20%. But understand that big picture, inflation is measuring a rate over change basis. The cost of crude has not materially shifted. Okay, then people are like, "Oh, this is how the COPE works on X." And as you're scrolling, "Oh, commodities. You can't look at DBC or GSG or DBC. You need to look at DBA because that's all crude. GSG and DBC are just crude." Then you look at DBA and you're like, "Oh my God, yeah, right. Look at this. Commodities are vertical." And then you realize 25% of this ETF is cocoa. And then you look at cocoa. Obviously, we know cocoa's up in a straight line, right? And then you look at something like corn, soybeans, it's all skewed, right? So we use GSG because it's the most balanced commodity basket there is in terms of what matters. Energy being the heaviest weighting because energy matters a lot. Okay, energy you need energy to do pretty much everything. And this is, again, we're still sub 2023 highs. So you take a step back and you look at this and you say, okay, a lot of people are screaming inflation accelerating. Inflation swaps not above 2023 highs. Commodities up off the 2023 or early 2024 lows, but still materially in the grand scheme not accelerating significantly. Commodities have strength. We've gone over this, but they're not running away from us to the point where it's like, okay, there's time, there should be concern. And then economy is surprising to the upside all around in terms of data. And we have the Fed in a restrictive stance in terms of the 1-year benchmark, which is the 1-year U.S. Treasury yield, and the 1-year inflation swap. The Fed is still 250 basis points pretty much over that in terms of a real short-term Fed rate. And that's restrictive in terms of where we've seen the Fed in the last 20 years. So the Fed is in a restrictive stance. Commodities are up, but we still can't, we cannot write this off as the I want to say this correctly. We can't say that this is not going to be a reversal down to Momo, chop around, and this momentum slows. Like that can't be written off the cards just yet. I mean, just because commodities are up like this in a straight line doesn't mean the Fed's lost control. We're turning into Zimbabwe. Oh, that's a lot of nonsense. And I kind of want to bring this podcast and wrap it up back with how we approach the market, because I think this type of holistic view is very important. And some of you might say, well, you're wrong on commodities. Commodities are up, 12% year to date. They're up more than the S&P 500. And my answer to this is yes, we're in a regime, if you understand what I'm saying, and you look at the quant deck, where commodities can have strength. The problem is the odds of you timing the inflation component versus the growth component is very particular, where inflation can switch sides very quickly from inflationary pressures to disinflationary pressures, and growth can remain positive. So if you understand what I'm telling you, it's much harder to time the commodities move than it is to time the risk on move. And I think that as long as commodities don't get ahead of themselves, they can trend somewhat higher. And in that process, as long as growth is persistent, I don't think they're going to be as problematic for the economy and what everyone is saying. And then I think you also have this other issue now with commodities going up. Obviously, we're in an election year. We're coming into the November election, right? So there's likely going to be, if commodities continue the strength, there's going to be reason to start dumping oil from the SPR. Everyone's focused. Americans are always focused on the price of oil, the price of gas, right? That's what we are focused on. That's what the government, the media focuses on. The president talks about the price of gas a lot. So if that starts accelerating even more, then the SPR is going to start getting dumped. At least they're going to start unwinding the SPR. And that's going to act as some sort of relief for at least some period B. Maybe it's only up until the election, but you understand my point. There's the Fed's restrictive. You got the government against you. Growth is positive. Inflation has some strength. But I don't think we're in that inflation dynamic that we were just, back in 21, where, I mean, you remember it, right? Like literally every week, they were underpriced. Everyone was not expecting the Fed to hike at all. It was like a rate hike at the meeting was unheard. Remember when we were looking at the FOMC meetings and we were literally doing these podcasts and we were like, yeah, the Fed's going to hike. And people were like, no, they can't hike. They're going to break the economy.
Yeah, like they can't even go up to 2%. Everything's gonna break.
Yeah, little do they know they're up to 2% in a swift stroke, and then they're on to 3%, then 4%, and then they settle at 5.25%. And it's like everyone I noticed, and it's something that you kind of have to just play the game to understand. There's a lot of people that claimed early 2020, not before COVID, but after COVID, that a disinflationary debt spiral was going to ensue. Yields were going to go negative, right? It was over. And as inflation started to rise, they were on the team transitory camp. They were looking, and some of these people are people that are on X right now with hundreds of thousands of followers. If you just go back in time and look, you'll understand what I'm talking about. And they claim, look, it's not real. Inflation's not real. Inflation's not real. And then all of a sudden, they finally break somewhere here when they realize the Fed is not breaking the economy with rate hikes, and they go, you know what? Actually, the Fed needs to go to 10%. Yeah. And for whatever reason, they claim 10%.
It goes back to our saying of it's never going to be as bad as they say, and it's never going to be as good as they say. It's always going to be somewhere in the middle. And I think we're definitely in that camp right now, where we have a lot of people thinking that there's going to be a secondary inflation wave. We're going to go through what we went through back in 2022. We're going to go through that again. And then we have people saying the market's going to collapse. There's going to be deflation because they're too restrictive.
Right.
But and I think the most likely outcome is they could hold rates here for longer than people expect. Growth can remain strong for longer than people can expect. And stocks can grind higher at a reasonable pace for longer than people can expect.
Right. And like, we just look at inflation, right? Like what most people are considering a second wave when they talk about this is they're for those that are listening and don't understand what a second wave is, most of the case or the claims for a second wave are assuming that we are going to repeat the 70s, the late 70s, where we take out the prior inflation high. That's what people are basically claiming. When they say second wave, they don't mean, a bump up to 5% and then a return. They're talking about a full-blown reacceleration. And I think that's all noise at the moment. I don't think there's enough supporting evidence to claim, look, that the Fed, like, we're not talking about the Fed. So what you need to understand, and I'm going to make this simple before we wrap this podcast up here. In 74, the Fed cut 75, the Fed cut way too quickly. And what happened is they let off the brakes so fast that the inflation surge was basically able to rewind higher, and they had to chase inflation back up. We are now at levels that they didn't get to in the 76 inflation pullback. We are 3.5. Now you're going to claim, oh yeah, inflation methodology has changed since then. Okay, we can play all the mental gymnastics you want. But long story short is the Fed is still at the same rate that they were when inflation was at 9%. They have not budged. Okay, so now the question is going to be, do we see inflation hit the 2011 peak in the next couple of months? Maybe it chops around in here for some time. Maybe it rolls over. But to sit here and claim that the Fed's completely lost control when we have zero indication that inflation is forget about breaking out to the prior highs. It's not even above the Fed funds rate, which is about half of the distance from zero to the previous inflation high. We're at 5.25, right? So we're not even above that. And you're claiming that inflation is reaccelerating. And it's just because macro people like to pick tops and bottoms, and top picking and bottom picking is not a successful game. So take a step back. If inflation becomes problematic, we'll start to see inflation expectations start to unanchor. We'll see inflation swaps start breaking out above 2023 highs, indicating, look, we might have a problem on our hands. We'll start to see commodities well above their 2023 highs in terms of broad-based baskets. We'll start to see firm pressure there. We'll even likely see that bleed into growth forecasts and the idea that, look, if inflation starts breaking up, then the Fed's going to have to, in fact, hike more. We may even see rate hikes at that point get pushed back into the curve, and we'll start to see growth get negatively affected. Or at least their forecasts. But until we start seeing any of those things play out, the Fed's in a restrictive stance. The market is chugging along for now. Inflation is under control for now, and unless these things change, you ride the wave. And I'd like to wrap the podcast up there. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on X at The Market Radar or on our website at market-radar.com.